Hello everyone, welcome to my channel. My name is Oshin and I'm not a financial advisor. In the series of videos ahead, we'll be taking a good look at investment opportunities that we have around us. Now, let's move straight to it. The first question we really need to ask ourselves is, are you balanced financially? Are you financially balanced? Are you okay with your current level of assets and liabilities? So firstly, before we look at the investment opportunities we have around us, we'll be dissecting what assets are, what liabilities are, and to see if we're actually balanced or not. It's always an excellent thing to have assets. It's also generally regarded as not so good to have liabilities, even though we could typically not do without having liabilities. We borrow loans, we have cars, we have houses that time to time take money from us. Now, the general thing that you want to achieve in your financial journey is to have your assets outweigh your liabilities. We're going to be taking a look at that. What are assets? Now, typically, assets are resources that you own that provide you with future economic benefits. They typically bring value by giving you income periodically. So examples of assets are your skills or your knowledge. The reason why we go to school, obviously, is to get a job and get paid for the skill or the knowledge that we bring into the business. Your cash, your investments, your inventory, if you own a store or you have a business that you buy stock for, you sell with the intention of having a little markup there and making profits. Now, what are liabilities? Typically, liabilities are anything that take money from you. It doesn't earn you additional income for owning it. You need to pay this for these items sometime in future. So, for example, you buy a car, you get a car loan, you service that loan. You buy a car, you need to maintain the car, you need to buy fuel into it. You get a mortgage and then you have a mortgage debt for the house you're living in and you need to routinely pay for that. Typically, those are liabilities. They take money from you. They do not earn money for you. Although there are some things that we might look at as liabilities that end up earning money for us. So for example, if you have a property that you probably financed with some form of mortgage and then you rent that out, that house is making income for you. It's an asset, but at the same time you are paying for the mortgage also. So a house can typically double as an asset and as a liability. So we'll be taking a look at all those scenarios. What do you do with your finances? The major aim of this channel is to help you increase your earnings, invest, and then keep investing, and obviously have financial freedom. That is the end point. That is the final destination. Financial stability. That is the final destination and the main aim for setting up this channel. So the question is, what do you do with your finances? Do you build assets for yourself, or do you constantly add to your liabilities? I advise you to evaluate your finances and try to know what areas are taking your finances and try to correct that immediately after this video. You could start by drawing up a simple budget and then drawing up your expense list, knowing exactly where your finances or your funds are going to part time every day. Try to track that for the next 4 weeks and see exactly how you spend your finances. That way, you'll be able to cut out things that you need to cut out from your list. You'll discover that you actually have wastage here and there. What we are trying to achieve in our financial journey is to ensure that our assets outweighs our liabilities. So for example, if your total asset is 500,000 naira and you have your liabilities at 300,000 naira, then you're in the green, you're okay. When your assets outweighs your liabilities, then you are fine. Now, if your assets and your liabilities are par, then it means you are typically living paycheck to paycheck and you cannot afford to have any emergencies because that will smell trouble for you. Now, when your liabilities outweighs your assets, then there is trouble. You need to take certain steps to drop your liabilities, to bring down your liabilities or increase your assets. Typically, that shows you a red flag there. What you're trying to achieve is that your assets should outweigh your liabilities. If that is not the case, you are currently living above your means. So, for example, you might be living in a 3-bed apartment in Lekki where you pay 2 million per annum or 2.5 million per annum, and you are not married. The question you should be asking yourself, why are you living in a 3-bedroom apartment in Lekki as a single person? Could you be looking at other alternatives? Could you be sharing an apartment with someone and paying less? You guys split the bills. Could you be living somewhere on the mainland rather on the island? Things like that. Also considering the amount you currently spend on transportation into the equation. Now, basically at the end of the day, you want to find those leaking holes, those leakages to your finances, those points that make you feel like you are flushing money down the toilet, and you need to plug them. You need to block them. You need to stop those leakages. Otherwise, it's only a matter of time before you run out of steam and your finances begin to suffer. All right, so moving straight on now, we want to define what investment is. There are two aspects and there are two ways we are going to look at investments in this video. One, in economic sense, investment is defined as a number of goods purchased which is not used for the present time but are used for wealth creation in the future. So for example, you own a store, you own a supermarket, you stock up your supermarket with inventory with the hope of selling all of the goods that you have in stock with a little bit of markup on it. Now that's investment to a business owner. I'm investing in my goods and I'm selling them with little profit margins on them. In a financial sense, investment refers to putting aside money with an expectation of future gains on it. So financial investments can be in many forms such as stocks, bonds, real estate, mutual funds, the money markets. Now for bonds, we'll be looking at government bonds, FG bonds, and saving bonds. We'll be taking a good look at all of that. Thus, investment in common language is planning for the future by deploying money in assets that have an ability to generate some gains for you over a period of time. So we see examples of investment opportunities here. We see bonds, equity, mutual funds, real estate, commodities. How to start investing? How do you start investing? How do you begin your investment journey, assuming you have never ever invested before in your entire life? What is the most important thing? The most important thing is that you get started. First, you need to put some money aside. You need to develop an excellent saving culture. Because let's say, for example, you intend to invest in the stock market, and you currently have a savings of about 5,000 naira. That might not go too far because 5,000 naira in dollar terms today is about $10. You want to save up that money to $100, $200, $300. Then you put it in the stock market. The yield at that time will be more as compared to if you started with 5,000 naira. You want to go into real estate, and the piece of land you need to buy is currently worth about 1 million naira. In the remote location you want to buy it, you do not have the 1 million naira to put in at once in purchasing the land. You need to save up before you purchase the land. Now, after putting some money aside every month if you're a monthly earner, or every week if you're a weekly earner, after doing that, the next thing you want to do is you want to determine your risk level and appetite. You want to look at things like how old you are, How many dependent relatives do you have? And things like that. For example, you cannot compare a 20-year-old boy or a 20-year-old person that is just growing up, has no wife, has no kids, his mom and dad don't depend on him. Compare that person to a 35-year-old adult that is married, that has kids, that has maybe his parents depending on him and siblings and all of that. You can't compare both persons. You need to determine your risk level and appetite. That will also help you in determining which investment opportunities you want to take advantage of. The third thing you want to do is now research the different investment instruments based on your risk appetite. For example, investing in the stock market is risky, but the returns on investment is high. Investing in government bonds has an extremely low risk because it's practically difficult for a government to collapse anyway, but its yields is very small. You have yields of savings bonds going like for 5%. You have money market or mutual funds going for about 4.5%. With the current inflation rate of about 12.5% in Nigeria, you are still going to be losing money. So you need to be able to research all of that. For example, I wouldn't advise a 60-year-old to go investing in stock. I would rather advise a 20, 25, 30-year-old to go investing in stock. And as you get much older, try to balance your portfolio. Try to balance the risk level. We'll be looking at that in subsequent videos. The fourth thing you want to do after carrying out your research is to build your portfolio. You need to build your portfolio around your risk appetite. How many percent do you want to have in mutual funds, in money market, in the stock market, in bonds, in real estate, in commodities, things like that? You need to build your portfolio. Immediately after building your portfolio, you start investing in the investment instruments you have selected. And you need to invest safer, just like I said, as you get older. You don't want to be in your 50s and then investing in stocks at a very large percentage of your portfolio. That could be risky. Imagine if you're a 60-year-old and the crash that happened in the market sometime this year when the Rona started, it could have taken you, it could have set you back 60-70% of your funds. You don't want to be taking that risk at 60. No. The final thing you want to do after investing in all of this instrument, the final thing is for you to retire early. Now, by retire early, I don't mean you stop working at 40 or you stop working at 30. No. I only mean at points like that. At that point, you sort of decide the kind of jobs you want to do or the kind of employee you want to become, or you could as well chase your passion. A lot of people have a job, they have an 8 to 5 job. They do it not because they enjoy doing it, but because they need to put food on the table. Now, the retire early here simply means you are much more flexible at which jobs or which roles you get involved with. Now, the types of investment opportunities we'll be looking at in this video and subsequent videos are stocks, bonds, investment funds, bank products, retirement funds, annuities, commodities, and of course, real estate. Over the years, I have gotten involved with all of these things, all of these investment opportunities listed here. Thank you very much for watching this video, and like I always say, please hit the like button, share this video. Someone might just need to hear this. Share this video, subscribe to this channel, click on the notification bell, and please invest safe. See you on the next video.